Good afternoon, traders and investors. Will back here with another one, coming to with a Sunday video, guys. And it's that time of the week again where we go over the top 5 options plays for the upcoming week. Hopefully all of you had a very nice weekend so far. Now keep in mind, in this video, all of these options plays are going to be for selling options, more specifically for selling put options as part of the larger wheel strategy that I like to run on the channel. This is a strategy that's allowed me publicly on the channel to make over 65% annualized ROI in 2024 and over 75% annualized ROI on the channel as well in 2023. Very easy strategy to run, guys, whether you're a beginner, intermediate, or even advanced investor. Allows us to collect some very juicy premium while benefiting from the volatility. It's a somewhat risk-averse strategy, so a more conservative one. And all in all, guys, it's just very, very easy to run and manage and doesn't require a lot of time. So in today's video, we have a few things to look at together. Number one, I'll be giving the expectation for the week. How do we stand in terms of technical analysis? How do we stand in terms of market breadth? And also, do we have any major catalysts in terms of macroeconomic data releases or earnings releases that could potentially affect the direction of the markets? Thereafter, we'll go over a few of the strategy rules that I like to look for when looking to sell put options in the market. And lastly, guys, of course, we have to go over the top 5 options plays. And as per usual, I'll be giving you a bunch of bonus plays as well. So make sure you stick to the end. So should be a very good video, guys. Let's jump right into the action, right? So in terms of the expectation for the week, well, we do have one very clear catalyst, which will be tomorrow, Monday. Now, tomorrow, Monday, the markets are closed in observance of MLK Day, third Monday of every single January. And we also have Trump's inauguration, formal inauguration tomorrow on the Monday session. So that could provide some much needed insight potentially into some early catalysts for the Trump administration in terms of any potential new policy that Trump may come out with some executive orders into the Monday session or Tuesday sessions as well. He's usually pretty quick with that thing. So we really need to be locked in and monitor the situation, whether or not he starts with some tariffs or a deportation headline or anything big that could possibly affect us. That will be Monday into Tuesday as well. In terms of the rest of the macro events, well, it's fairly light. Not much in terms of macro. Only on the Friday do we get the manufacturing report. So until that time, no other macro news events will be notable. In terms of earnings, the biggest one of the week arguably is Netflix. That will be Tuesday after the close, and that will probably have somewhat of an impact on tech, either to the upside or to the downside as well, in terms of earnings revisions and profit guidance for the entire year. Otherwise, we do have a ton of different earnings, but none of them are truly as big as Netflix because Netflix has the largest market cap of the bunch. But there are a few notable, interesting names throughout the week. The second of which is maybe American Express on the Friday session, and Texas Instruments will be providing us some good insight into the semiconductor trade on the Thursday session after the close. So the start to few very big earnings weeks in the next few weeks. Netflix is this week, and then the week after that, we get almost all of the rest of big tech. Tesla, Microsoft, Apple, Amazon, and Google will be the week of February the 5th, of course. So keep that in mind. Meta as well, not this week, but the week after. So should be a lot of earnings coming out in the next 2 weeks. And I do really think the markets will be largely moving off of these earnings results and any formal policies that Trump puts into place over the next 2 weeks of time. So that is your expectation for, in terms of the macro catalyst, the earnings catalyst. Where do we stand in terms of technical analysis? Well, the SPY bulls did a very good job last week of bouncing the QQQ bulls as well. It was a daily downtrend. We now have a 100% engulfing move, creating a ton of space off of the lows. So we will be monitoring if the bulls get stopped out here in this area of resistance and have to gather their strength. They have a ton of space, guys, to set up for a higher low for a possible trend change. So if we start seeing some dips like this, I will be using these dips as a buying opportunity in some of my favorite stocks to go shopping for, to write some puts under the market in the event we have a little bit of a pullback early on in the week, Tuesday and Wednesday. But all in all, the technicals are looking good. Nice engulfing move on the weekly timeframes as well, putting an end to some of this brutal weekly consolidation that we've seen since Jerome Powell. So all in all, I am a fan of buying these dips, but I will be buying them slowly and writing puts under the market. That's why I love writing put options, guys. You don't need to time the actual bottom. If you get a dip, we can write puts down here. And if we get filled, no problem at all. We'll be getting some fantastic levels. The QQQ, same analysis, almost a 100% engulfing move. It was a daily downtrend, of course, a lot of space being created off the lows and above the support 515 down to 510. So big tech does have a little bit of leeway here. Anything above 499, let's call it 500, looking for a daily higher low for further trend continuation. So that's why I say if we do get a little bit of a dip in tech, we can be writing some put options all the way down there on some of your favorite names. Just use the QQQ as a proxy. If we're dropping on the Qs, it means we're probably dropping across all of big tech. So we're going to be taking a look at some levels that I'm interested in going shopping for big tech if I can find them this week. So that is pretty much everything the expectation, guys. The market's not looking too bad. A lot of cushion in terms of technical analysis. The fear and greed index is also starting to pivot from extreme fear levels back over to somewhat of neutral, and the market is broadening out as well. We can take a look at a few of our broadening sentiment indicators right here. Percentage of stocks above their 20-day moving average. This has gotten a lot better in the last week, coming off the lows of 28%. We're now back within the historical averages, around 62%. Percentage of stocks above their 50-day, you can also see we are curling higher, so more and more of the market is recovering. Percentage of stocks above their 200-day moving average, the longer moving average, also recovering from the depths of the extreme fear lows. So not looking too bad, guys. The market is broadening out. Take a look at the 1 week relative. You'll see a lot better job of the market broadening out than has been the case since Jerome Powell, right? A lot of the value trades have been coming back. Take a look at SCHD off the lows. This is the dividend ETF, the value in ETF as a whole also bouncing from the lows. So we know the bulls have done a good job. The bulls are not out of the woods yet. Still need to confirm the trend changes and really get more of a sustained rally in the bottom half of the market. But all in all, so far, so good, guys. I will be slightly cautious this week, but I will be looking to go shopping nevertheless, using short puts to do so. So in terms of short puts, here is the strategy, guys. These are the put wheel rules. So what is selling puts? You might have realized over the past couple of minutes, I've been talking about buying the dips by selling put options. What is selling puts? Very simply, guys, it is a buy limit order under the market that pays you. If you want to buy, let's say you want to buy a stock like Apple on this dip right here, right? And you want to buy it at 220, but you're not too sure if it's going to get there or not by the Friday close. There's two ways you can do that. You can set a buy limit order here for 100 shares, but if Apple never gets there and just rallies, you don't get any shares, you don't get any money, right? It just kind of sits there and does nothing. That is where selling puts comes into play. It is a buy limit order that pays you. If I pull up the options chain, let's say on Apple for the week, let's say, let me pull up Apple and we'll see what we can get around the 120 mark. Now, I know these chains like the back of my hand, so we're probably not getting much there, but I'll just give you a theoretical example, right? So if I'm looking to write the 220 puts for this Friday close, January 24th at 220, I would pocket $40 or 40 cents per share. Now, it doesn't sound like a lot of money because it's relatively far away. I'm just giving a theoretical example. But if Apple were to pull down a little bit more and you find even more premium at this strike, something like $1, $100, $110, something like that, which would be roughly $1 on the strike, then you're actually collecting $100 just for placing a buy limit order there. If Apple ends under 220 by the Friday close, you get to pocket that $100. You get a discount of $1 per share in terms of your average cost, and you end up buying the shares at 220 like you wanted to the whole time. Now, in the event that Apple does not close below 220 by Friday, you just get to pocket all of this premium, put it in your pocket. You don't have to buy any shares, and that's that. That's the trade pretty much. That's why I say it is a buy limit order that pays you whether it gets filled or not. So here are the strategy rules, guys. We're going to fly through these because if you haven't seen my 30-minute video on the strategy rules in detail, I'll leave it down below, the link in the description. But for now, we're going to fly through these rules. I will take for granted that you guys largely know them by now because I do go over them every single Sunday. Now, the first thing you want to do is build a watch list of your favorite stocks, high conviction stocks, and filter them by red. Monday, Tuesday, Wednesday morning, you filter this list by red, and I'm only looking to go shopping for stocks that are red. Why? Well, when we take a look at the rest of the rules, it'll make sense. So number one, we want to be looking for high quality and high conviction companies only. Why? Well, because selling puts entails that you may have to be assigned the stock, meaning you might have to buy the shares at the strike price. So you might as well want to buy shares of a very solid high conviction company. Because if you end up buying the shares and the stock goes down and you don't like the company, you're going to be wondering what you're doing in that company in the first place, right? So only high quality, high conviction company stocks. This is where I would say 95% of people get this strategy wrong. You play the wrong stocks. Play stocks that you have high conviction in, and that way, if ever you get assigned, which is somewhat rare, at at least you won't have to go through an emotional process of trying to manage the loss and wondering what the company is doing. You know what I mean? You'd have higher conviction buying some shares of, let's say, Google than you may buying some shares of Etsy or some shares of some other company that you don't know much about. So this is rule number one for a reason, guys. Do respect the rules. Number two, we want to be looking for stocks in a monthly uptrend or a long-term range. Well, a monthly uptrend looks like the SPY, right? Very beautiful monthly uptrend. A long-term range could be something like a Microsoft as well, where for the last year of time, we've been in a very long-standing range. So every time you see me take a trade on the wheel strategy, guys, it'll be one of those two things. Either it's a monthly uptrend or some form of a long-term range of accumulation. All of these criteria just put the odds in our favor of not being assigned the shares. Number three, we want to be targeting companies that have no earnings this week. So if I see a company has earnings this week, guys, I will not be playing it. Yes, you can get far more premium on stocks when they have earnings during a week, but then again, it is very volatile. You guys know this best. A stock can have very good numbers and still go down 5, 10, 15% after earnings. So if you want to avoid any nasty surprises and nasty losses, do not play any short puts on companies that have earnings this week. In my experience, guys, it is just not worth it for most people out there to take that risk. Number four, you want to be playing stocks that are in a support area or an area of breakout retest. So a support area, very simply, is exactly what we saw like Microsoft. When we come down into a larger range of support, this is the weekly time frame. When we come down into this very large area of support, 400 down to 390, this is the area that I love to write short puts in because it usually gets a nice little bounce from the bulls every time we pull back into there, and we can usually close these trades at a profit. The other form is the breakout retest. I'll show you what the breakout retest is. Long-term range of accumulation, then we break the range to the upside, break through all this resistance, then we use it as support, breakout, retest, and run. This retest location, otherwise known as the trend continuation trade, is a very high probability setup as well, at least for a first attempt at a continuation, right? So all the trades you see me take with this strategy will be respecting one of those two criteria, either a support or a breakout retest. Now, number five, we want to be writing at or lower than the expected move. This is where we choose to write our strike prices, how we choose our strike prices. If you don't know what the expected move is of a stock is in a given week, just go to barchart.com. Just type it into Google, bar chart, Nvidia or Apple or whatever stock you want, bar chart, Nvidia expected move. You'll come to this page right here. Here you see I have Square and they have the expected move right on the chart right there. You want to be writing below the expected move, below the lower price of the expected move. Once again, it adds odds in our favor of not being assigned. If a stock goes too close or below its expected move too soon in the week, usually you do get some mean reversion and a bounce at the midpoint through the week. So that is what we want to be targeting, guys. We want to be as low as possible below the expected move, once again, to improve our odds of not being assigned. This goes in with the following point as well, writing on a red or flat day. It stands to argue if we want to be writing below the lower end of the expected move, the stock has to be red. If the stock just moons on Monday or Tuesday and goes higher, we're not going to chase to the upside, guys. We will not be able to write below the expected move. So in that case, if a stock just rallies, right, we just move on to another trade, guys. Just forget about it. But you always want to be looking for stocks that are red or on a flat day so you can write below the expected move. Now, moving on further, this is our ROI per week. We want to be making between 0.5% to 0.75% per week. Roughly, if you're doing that with your entire capital every single week of the year, you should be making 52 weeks times 0.05, which is 26% to around 30% annualized without any compounding and without the benefit of getting boost in ROI from covered calls. This is the baseline. The baseline of 26 to 30% per year, guys, is like 2.5 times the long duration SPY yearly annual gains. So this is a very good return. It is an optimal return that after running this strategy for the last 6-7 years, this is the sweet spot, guys. It has a low risk of assignment, meaning you'll have a very high win rate for the strategy, but you also get paid a decent amount of ROI. What does this rule mean? Well, if we go to the options chain here, guys, I'm looking for 0.5% to 0.75% on a given strike. If you don't know what that means, I'm referring to the amount of premium that is available on the strike. You will see if I divide 1.04, let's say we take the 225s here, divide 104 by 225, and you will see it is not quite 0.5%. Very close, but not quite. If you guys want to know a way to do this very easily in your head, guys, take the strike price, divide it by 2 in your head, and that is the amount of premium that you should see on the bid right here, right? So half of 225, let's say it's roughly 111, 112-ish, something like that. And if you want me to prove it to you, divide 112 by 225 and you'll see it's exactly 0.5%. This is a way that you can go through tons of options chains really quickly without looking for delta, because a lot of people use delta. The problem with delta, guys, is that the delta divergence, depending if you're looking at the Apple options chain or the Nvidia one or the Coca-Cola one, the deltas will be at different varying degrees of distance from the strike and will provide different amounts of ROIs. So if you want to avoid having to always look for a specific delta or whatnot or something like that, right? You can use the 0.5% rule. The 0.5% rule is adjusted for IV. It's adjusted for delta as well, right? So moving on to that, if you want to look at a ton of options chains really quickly, you can just look at the strike price, divide it by 2 in your head, and that's the amount of cents that you need to see on the bid right here. So hopefully that makes sense. Then lastly, we want to set a take profit order at 90% of the contract value. That just makes sure we're being capital efficient. If we write these options on a Monday morning and by Tuesday afternoon or Wednesday morning, they're already 80-90% profitable, it serves no purpose to hold the contract into the end of the week, guys. You may as well just close the trade and go shopping for a new trade that provides full amounts of weekly premium rather than riding the remaining 10% into the end of the week and just, it's just not capital efficient, right? Then if ever we get assigned the shares, if we have to buy shares because we get assigned at the strike price by the Friday close, we will be writing covered calls to get out of those shares. The selling puts is a buy limit order under the market. What we're going to do thereafter is we're going to use a sell limit order, which is known as a covered call. For my covered calls, I always want to be targeting the same thing between 0.5% and 1% in weekly premium. And I'm going to be writing at my assigned strike price or 1 strike higher. So if I get assigned Apple at 220, the next week I am writing 220 covered calls on my assigned shares. The only time you'll find me writing 1 strike higher is, let's say I get assigned on Apple at 220 this week, and then the following Monday, for some reason, it just gaps up to 225, right? 4 or 5% gap up right away. Then I may write 1 or 2 strike prices higher than my assigned price, but I would say that's very rare, guys. 98% of the time, you'll always see me writing at my assigned strike price and just running the wheel, right? We get into the stock with the short put, we get out of the stock with the covered calls, you just take your capital back and you do it all again. That's why we call it the wheel. So that is everything for the strategy rules. Hopefully that was helpful, guys. And now let's move into the top 5 options plays, shall we? So play number 1 has been one that's been on the channel now for several weeks, arguably several months in a row. Why? Well, because it's still at a very good level. And I love playing the same stocks if they're providing the same levels, right? Nvidia down here, 130 down to about 125 has been support for Nvidia ever since the month of October. And I do not think that will stop unless the SPY and the QQQ really take a large tumble. So I do like playing the 130, 125. Preferably, I like to be between 125 and 120. That is my ideal location for Nvidia, because if Nvidia were to come down there and I get assigned and the stock is down 20%, usually that's the extent of the drawdowns on Nvidia, right? 20, 25% in all of the consolidation phases. You can go back a year of time, even in fall of 2023, right? Take a look, about 20%, 25% is maximum drawdown. So that is really why I want to be in the lower 120 range. But as of right now, we do have below support 130 to 125. So if we can find under 125 this week, that will be very, very good. Now, I think I moved the line. So let me just double check that I didn't move the expected move too much, or that's going to kind of change the strikes we're looking for here. So let me just go back. My bad, guys. Let me just do it again. So NVIDIA expected move. So the NVIDIA expected move is 133.52. I did move it up. I moved it up $1. So let me just change that real quick. So 133.52. And let's go shopping for NVIDIA. See, can we find below this expected move, can we find some premium down there, preferably in the mid 120s? So let's go have a look together, shall we? So let me pull up the NVIDIA options chain and I'll show you guys what I mean. So NVIDIA, we're going to be looking below, let's say below 130, right? 130, you can see there's not enough premium there. Divide 130 in your head by 2, that is 65. You need to see at least 65 cents on the bid for it to be worth it. As we can see, that is not there yet. The only premium that is there is around here, the 133s, which is below the expected move. So essentially what I'm saying is we have to wait for a dip. If Nvidia dips down into the expected move, that will most likely free up the 130, maybe even lower strikes than that. So at a first glance right now, the 133 strike is below the expected move, but it's a little bit too high for me. I would rather wait for a dip on Nvidia, and that's going to probably free up 129 down to possibly 125. You want to be going as low as possible while still getting the required amount of premium down there. And I'll remind you, if we're looking for 130 to 125, you'll need to see about 65 cents on the bid. So watch for the dips on Nvidia, guys. And if it does happen, that is going to be a very nice opportunity for us to go shopping through the intermediary of short puts. The other semiconductor play that I'll be looking at this week is AMD. So we know that AMD breaks a few of my strategy rules. It is a monthly downtrend, and we are also not truly in a large range of consolidation. The reason I like this one, guys, quite simply, is because AMD has just been so unfavorable, and the valuation is extremely good right now. Not just AMD has been out of favor. A lot of very strong semis have been out of favor too. ASML has been out of favor. Micron has been out of favor. LRCX, another very strong company, has also relatively been out of favor. So it's not just AMD, right? So AMD has been one that's lagging behind, exceptionally lagging behind at this point. But I'll remind you, the valuation down here is very cheap. They're growing very well. And the thesis for AMD, this is just the market's thesis, right? Is that they will be expanding EPS and expanding revenue in a very good fashion into the next 2 years of time as they ramp up their data center offerings. Now, we're not saying they're going to beat Nvidia. We're just saying they're going to participate in the data center ramp and have at least some market share between 5 to 15%, let's call it, right? But one thing's for sure, these will be, in the next 2 years for AMD, the best revenue and EPS numbers that the company will ever have posted in its entire existence. So I do want to participate when the sentiment is down a lot. People don't like the stock and whatnot. That is when I want to be buying, right? That is just my thesis, fundamental wise and market sentiment wise, but I know this stock is very polarizing. You either like the play or you absolutely hate the play. So feel free to either take this one or skip it over altogether. That being said, the expected move is 117.91. So if we go on the options chain, I'll be looking below, let's call it 118 on AMD to possibly go shopping, right? And just so you guys know, I am already in this one. I already have a January 31st. I went a couple weeks away, 115 put. You can see it here. I'm already in. I got almost $2 for mine, but I am in, guys. So I am participating in this one. I am already in a bit earlier than you guys, but if you guys want to possibly make an attempt at the same strike, completely up to you, right? So below the expected move of 117.91, you can see that there is some premium here at the 117 strike. There is 57. Now 57 is right under the the required premium. It's only off by a couple pennies, right? So when you see this, it's not bad at all, right? Almost 0.5%. I would not mind taking those. However, if you see another dip on AMD, because they have been frequent and not that far between, right? If we see another dip and we drop down into the expected move, coming back down 118, 117, that will most likely free up the same strike as me, the 115, or maybe you can even get a better strike than me. Think 114, 113, 112. As low as possible, guys, because we want to be targeting this support range below 112 down to 100. That is the big area of support coming up very shortly for the stock. So I want to be going down into this zone. So be patient with it. Don't chase the market. But if we do come down and it's an opportunity that you as well want to participate in, for me this week, it's going to be 115 all the way down to 110, as low as you can possibly get while still getting roughly 65 cents on the bid. Hopefully that makes sense. Thereafter, guys, we're going to move into trade number 2, and that's going to be Elf Beauty. Elf Beauty has also been a recurring stock on the channel. I've been saying that whenever it has some decent drops, I will be playing. And as you know, I do have skin in the game as well. I have an Elf Beauty short put here for the Friday session. 115 is my strike, and I got 64 cents. So right above 0.5%, I'm very happy with my position. And you can see that it is roughly around the same price that I got for it as well. So Elf Beauty, very easy stock to play. They have a lot of very good secular trends behind them. They do not have a lot of overhead costs because they do not have physical stores. Most of their business model is done online. Their marketing strategy is using other TikTok and Instagram influencers to promote their products. And overall, the company does not have that much overhead cost in terms of physical locations. They spend most of that budget on marketing, viral marketing on social media, which is arguably the correct way to do things in this current day and age. That being said, the fundamentals of the company are very good. They're expanding revenue and EPS at very attractive clips, as you can see. Expansion of EPS the next few years, expansion of revenue as well, and the company is indeed profitable right now, so not looking too bad for Elf Beauty. I like the company, but I like it in the low 100s. Talking about 115 down to about 100. That being said, big sell-off day on Friday, no news at all, but you guys have seen Elf Beauty is always volatile, right? If they come back down into this area, guys, this is where I want to be buying the stock, and that is why I have a position already at the 115 strike that you can see right here. So the expected move for the week is 119.91. We want to be going below that, so let's go shopping on Elf Beauty and see what we can find. Well, if you saw my contract, you probably already have a guess of what we can find, right? 115, guys, for 60 cents. That is the strikes that I want. 115 down to 110. If Elf Beauty has another decline Tuesday morning when the market opens down into 125, 24, 23, 22, or even lower, think that you can get even lower than me. 115 all the way down to 110, guys. As of right now, the minimum premium you can get is at the 115s because lower than that, there's not enough ROI. But if Elf Beauty drops, think as low as you can go, guys. 112, 111, 110. So at a first glance for me, 115 down to 110 as low as possible. And if for some much reason Elf Beauty has a minus 5-6% day on the Monday, coming down already into 117, maybe you look all the way down into the 105s, 106, 107s. The art of this strategy, guys, is being dynamic and adaptive depending on the size of the move to the downside. Do not have a defined level in your head. React to how far the stock has come down. Go as deep as possible on the options chain while still getting your 0.5% rule, okay? So that's how I want you guys to play this strategy as a whole. If you do like it, stock number 3 is going to be Palo Alto Networks. Palo Alto was featured on the channel for the last 2 weeks as well. Why? Well, quite simply because they came down daily oversold conditions. They came down below the 200 daily moving average, and they did come down into the most relevant area of support that was close, the roughly 170 down to 160, and bouncing from there nicely too. Now, Palo Alto was down about 20% from the highs, and you can see the stock is in a very nice monthly uptrend, very nice, well, was a weekly uptrend, just had some consolidation and pulled back to the 50 EMA on the weekly, which usually in the last 2 years has been a decent buying opportunity for Palo Alto Networks in the context of the bull market that they're in right now. Very profitable company, one of the cybersecurity leaders of the entire industry, them and CrowdStrike, and probably my favorite cybersecurity play that I like to play in general. That being said, we did have a nice little pop here. However, if we start getting some retest, because the bulls eventually do need to set the higher lows and go for the trend change, if we have some further declines with the SPY QQQ or elsewise, or otherwise rather, Tuesday, Wednesday morning, and we come down into the lower 170s, that's going to free up some premium into the support range that I want to play, guys. Think 170 down to about 160, as low as we can get. As of right now, the expected move is 172.85. So let's go shopping together and see what we can find on Palo Alto Networks below that roughly 172 mark. So when I pull up the chain, you guys will see. Well, unfortunately, at 172.50, which is slightly under the expected move by about 30 cents, at 172.50, barely enough premium, right? You need to see arguably 85 cents on the bid right here. And although it's close, it's not quite there. So what we need to see is a further decline on Palo Alto. Let's call it coming down 175, 174, even 173, Monday and Tuesday. That is going to free up the lower strikes that we actually want. 170 and 167.5. I'll remind you, you will be looking for about 85 cents on the bid, but it will require Palo Alto to have a little bit of a dip. So be patient, put it on the watch list. And if we have a dip and you like the company, you like the play, this is the area that I will be looking for, guys. 170 down to 160 as low as I can get. But at a first glance, it's really these two strikes for me, 170 and the 167.5. You have to be dynamic though. Obviously, if Palo Alto has a, for some reason, 4% down day on the Tuesday, because that's always possible, right? Then you adjust your strikes lower, guys. You go for the 165 or 162.50s. as deep as you can get in the support range, which is 170 to 160. You want to get as deep as possible, put all the odds in your favor, and get the best possible price if ever you have to buy the shares. Now, plays number 4 are going to be a combination of 2 big tech names that I think are at attractive levels right now. One of the 2 is Apple. Apple's had a tremendous decline recently, top to bottom, pretty much down 12%. But usually when Apple comes down 12 to about 15%, it usually does represent a decent buying opportunity. Here is the August sell-off. Here is the sell-off from December through early April this year. That was 17%. This one right here as well was about 15%. In the context of a bull market, right? So if Apple comes all the way down there, 220 or lower, that will be your sell-off of roughly 15%. And look what we have here as well. We have the daily 200-day moving average, and we also have this very long-standing range of support, which the bulls have built for all intents and purposes since the month of July. And the 50 EMA is also there as well at 218. So this is a very big area of confluence. And as I showed you guys, I am already in Apple 222.5 puts for the Friday close, and I got $1.13 for them, roughly about 0.5%. So I will be looking to maintain this position on Apple, but in the event that we get further declines, maybe if you guys are interested as well, it could be a possible opportunity out there, just throwing out the idea. That being said, the expected move on Apple for the week is 225.24. This is a very nice weekly move, looking for the breakout, the retest, and possibly a little bit of rally, because now we are very close to daily oversold on Apple. So I'm just looking to play a little bit of a bounce here. So Apple, taking a look at the expected move of 225.24. Let us have a look here, guys. Can we find some good premium on Apple below the expected move? And as we can see on Apple, as a matter of fact, we actually have almost the same strike as me, but not quite. It would have to be the 225s. 225s is a little bit high. Essentially what I'm saying is we have to be a little bit patient, guys, and wait for the stock to dip a little bit. If it comes back down to the lows of where we were, or even lower, coming into, let's say, 227, 226, 225, that will free up arguably maybe even the same strike as I have, or maybe you might be even able to get the $220 strike, which is right at the 200 daily moving average. So that being said, my favorite strikes for the weeks are 222.50 and 220, depending on the size of the move to the downside and what premium gets freed up. Obviously, if Apple has a 3% down day on the Tuesday, which is always possible, well, then we want to go lower, right? You want to go for the 220s, the 217.5s. Just be dynamic with your strikes. That is it for Apple. And then trade number 2 is going to be Google. Now, Google also has been establishing some form of a range of support down here, 190 to roughly 188. So I do want to play this lower end of support. If ever we have a bad start to the week, I will be looking to accumulate some Google, sheerly because although it's not at a very big level of support, my favorite one is down here. It is at a close level of support, and the valuation of this company is extremely good. The momentum is good as well. So this one is kind of a hybrid, right? Yes, it is support, but I am looking to play some Google momentum. If I get assigned here, I don't mind, because I will be looking to ride the shares a little bit higher. So this is like somewhat of a momentum play, but also it's a very logical play too. Google should be having a very good year. The valuation is very cheap compared to its sector peers. So I do not mind playing it here, but if you're a more conservative trader, you may want to wait for more of a flush into the mid 180s. So just keep that in mind, right? This is a little bit more aggressive, but then again, the play itself is a bit more aggressive, but the company I'm choosing to do it on is somewhat of a very conservative company, right? It's Google. It's not as if I'm doing this on Bitcoin, right? So moving on in, the expected move for Google is 193.36. That being said, the lower end of support down here is 191 to 188. I want to be getting as close as possible to 188, and the strike there is 187.5. So let's have a look here on Google, and you guys will see what I mean. So pulling up Google, and let's have a look. So moving into Google, the expected move for Google, as we said, was the 193.36. We want to be below that, preferably down here towards the 190s. And as you can see, at the 190s, you're not getting enough premium there, guys. You would have to see 95 cents, which is half of this price. You would have to see about 95 cents at the bid here. Unfortunately, it's not there. The best you can get is at the 195s, but 195, number one, it's too close to the price, and it's also above the expected move. So it stands to argue we have to wait for Google to decline, right? But if Google does decline, it is right there on my watch list, guys. If it declines into the low 190s, probably going to free up the 187.5. So for me this week, it's one of these two strikes, depending on how aggressive we want to be. More aggressive would be 190. Less aggressive would be 187.5. I would not mind being assigned some shares in this lower range of Google, although the ideal location is low 180s. I'm just not sure if we're actually going to get the low 180s much before the week of earnings, which is February the 5th. So keep that in mind. That's what I'm looking for on Google. Those are plays number 4, Apple and Google. And now for play number 5, it's going to be a combo of 2 fintech plays that I've been bringing up on the channel for the last few weeks as well. Number 1 is going to be SoFi. SoFi's been on the channel for a while now, but we play it conservatively. We know that SoFi has had a very nice engulfing move, creating a lot of space off the lows of 1358, and we'll be possibly looking for the daily uptrend reset to possibly go attack the 18 all the way to $20 range sometime over the next 30 to 90 days would be my best guess if the bulls want to manifest that rally to the upside. So that being said, we could have a very nice opportunity if SoFi pulls back early on in the week to maybe lock in some premium at the lower end of support, which is arguably $15 down to about $14, depending how aggressive you want to be. Daily MACD has now been crossing after the last few weeks of consolidation. Could be looking for some momentum follow through, and the weekly also big weekly engulfing candle reacting nicely from the prior support range, which was established in 2021, 2022. We used the bottom end of it, and now the bulls are bouncing nice. So I do want to play the dips if we come down here, guys. But we have to play them a little bit, conservatively in the event that the market just flips from bullish to bearish overall this week because of Trump or because of XYZ event, right? So that being said, if we look at the SoFi, if we're looking at SoFi options, I'll just let you guys know the expected move for SoFi this week is 1568, so relatively close to the current price. However, SoFi gives some good volatility, so we can probably get lower. Look down here, guys, right? So the expected move, 1568. Take a look. At 15, you can arguably get 0.5%. It's not there yet. I know it's only 6-7 cents. You need to see about 7-8 cents, but it's arguably right there, right? From 16.50 down to 15, guys, it will be a sell-off of 9%. SoFi can go down 9% in a week. However, if we see on the Tuesday or Wednesday morning a flush down back into the mid-15s, that will free up a lot more premium, not only on the $15 strike, but maybe even the 14.5s. So at a first glance for me this week, I want the 15 strike or the 14.5s, but I need to be waiting for a dip for them. So keep that in mind. That is the trade I'll be looking for on SoFi. And of course, if for whatever reason SoFi on the Tuesday session has a big 7, 8, 9% move, like we've seen so many of them in the past few weeks, if you have a big move down, you move it down to about $14.5, $14. So what I'm saying essentially is $15 to $14 as low as we can go while still getting some decent premium. Hopefully that makes sense. And play number 2 for fintechs is going to be Square. So Square as well. Square is a longer duration breakout retest pattern, right? On the monthly, you can see this very clearly. Well, there's a few things happening here. Number 1, it's the most beautiful inverse head and shoulders that I've ever seen. Number 2, cup and handle on the monthly. But number 3, most importantly, it's just a big breakout retest. Breakout of 2 years worth of resistance, broke it out, now retesting and possibly looking for the run. It is correlated with Bitcoin, but do not forget Square has 3 entirely large businesses of its own, right? They have their Cash App platform. They have buy now, pay later. They also have banking, trading, and loans. But they also have their merchant sales terminal, the little white squares that you guys see oftentimes when you go into different stores or restaurants and pay with the Square merchant platform. They have that business too. And the business, even right here at $90, is extremely, extremely cheap at only a 0.73 peg for all of this revenue and EPS growth through 2027. So the valuation is good and the technicals are also looking good as well. So that being said, the expected move for the week is 83.75. I want to be going as deep as possible into the lower 80s as I can get, because just looking to get some good exposure before maybe embarking on this rally to the upside. So I do think that these dips are a good buying opportunity if you like Square as a company. That being said, the expected move, 83.75. Let's go shopping for some Square and see if we can find anything below that expected move, shall we? So looking on Square real quick. And you can see right here, Square, right? The expected move, 83.75. We can go all the way down maybe to the 83s. You'd have to see about 41 cents on the bid, and we're getting more than that. But the 82s are also there as well. Almost 40 cents on the bid. You'd need to see about 40. They're almost there. So what you'd really need to see in an ideal scenario is a little bit of a further push to the downside into the expected move. Think 85, 84, high 83s. That will definitely free up the lower 80 strikes. Think 82, 81, $80. And these are really the ones that I want. 82 down to $80, depending on how construed conservative or aggressive you are, these are the strikes that I'll be looking for. Deep, deep, deep into the support zone, which is also the retest zone for the monthly bulls, right? So hopefully that makes sense. You want to be going as deep as possible. You see this zone best on the weekly, right? You want to be going as deep as possible into this retest area, you know, $82, $81, $80. So that is pretty much everything for the top 5 options plays, wrapping it up. Hopefully you guys were able to find some form of trading ideas with that and understand the strategy as well. Now let's get into a bunch of bonus plays. And there is many bonus plays because there's many opportunities in the market. These bonus plays, keep in mind, guys, that a lot of them are very good plays, but number one, they're either aggressive, too aggressive to be in the top 5 options list, or number 2, they are almost ready, right? So we're gonna be taking a look at a lot of bonus plays right now. So I'll just be giving you the actual plays. We're not gonna be going over the expected move of each one, but by now you guys are probably experts in being able to look at the expected move and then look on the options chain as well to go shopping for some premium. I'll just give you the levels in which I'm interested in playing them. Number 1 is gonna be BITX. So BITX is the 2 times leverage version of Bitcoin, of course. And if we possibly see a little bit of a dip in Bitcoin, I think down here, guys, the lower 50s to high 40s range is where I continuously want to play Bitcoin. You know, Trump is known as the more favorable president in crypto's history. And if we get a slight decline here as some form of a sell the news event for the inauguration, well, then if we have a decline, I will be looking to buy Bitcoin, possibly down here around the 90K range, which on BITX would be synonymous with the lower 50s to high 40s. So that is the range I'll be targeting on BITX for the week. Once again, look for 0.5% in premium. Do not play these ones too aggressively, guys. These 2 times, 3 time leverage ETF trades, you can play them very conservatively. Do not get seduced by the amount of premium that they're providing close to the strike. It's a very easy recipe to get trapped and build up a loss very quickly. So the way I play these is very conservatively with a very wide margin of safety. So keep that in mind, please. This goes in line with the next play as well. Tesla 2 times leverage shares. So because not a lot of people have the actual buying power to play actual Tesla short puts, because each one, if we're targeting 380 as a support zone, right? To write short puts, that's $38,000 in capital. So if you want to be a little bit more conservative with your capital, we can use Tesla 2 times leverage. But because it's 2 times leverage, we have to be a little bit more conservative. That being said, I like these lower ranges down here. $23 down to $20 is it for me. So if we drop on Tesla early on in the week, that could be a nice opportunity to find some premium down here, $23 to $20. Once again, we're going to be looking for 0.5% to 0.75%. Not going to be looking to get too aggressive with my strikes, guys. Easy way, especially on leverage ETFs, to just get trapped and mount the losses a little bit quickly, right? So play these conservative if you are playing them at all. Another 3 times leverage product that I like playing is SOXL, also a cheap one in terms of share price, but it doesn't mean that we have to be too aggressive. I like SOXL down here, 27 down to about 23. If we have a retracement down in semiconductors, that'll bring SOXL down and could free up some decent opportunities here, 25 down to about $22. Early last week, when we dipped down here on the Monday, I got the $22 strike, and in 1 day's worth of bounce, I was out of that trade with a ton of profit in terms of ROI percentage, right? So keep that in mind. If we dip a little bit, I'll be looking for SOXL. 25 roughly down to about $22 is my sweet spot that I look for. Once again, not getting too aggressive on the premium and not getting too aggressive chasing the market too close on the strikes for the 3 times leverage products. Another one possibly is SMCI. This one too, somewhat more aggressive, but you can play this one with a fairly conservative strike. Keep in mind for SMCI, guys, look at how far you can get down below the current market price while still getting 0.5%. You do not need to play these too close, guys. It is just way too volatile to do that, right? So let's have a look where the 0.5% rule is for SMCI. It's down here at $25 for Friday close, which means that would require SMCI to drop 18%. That is a decent margin of safety. If SMCI has a red day on the Monday and comes down 3, 4, 5%, we'll be able to get even lower, maybe 24, 23, 22. You want to be going as low as possible, guys, because these stocks are very volatile. And if you do have to end up buying them, well, at least you're buying them at a very attractive price and a very attractive 1-week discount. The other ones we're going to be looking for are some of the high quality names, but that maybe some people cannot afford. One of those is Microsoft. Microsoft daily downtrend, engulfing move, looking to set the higher lows for the possible daily trend change. If Microsoft dips back down here into the low 420s, that could free up some decent premium. 415 down to 410. We can play these on a 1-week basis, but we can also play them on a 2, 3, 4 week basis. It's a little bit sketchy though, because they have earnings Wednesday the 29th. So it depends if you want to play this one this week and then be out before earnings, because if you write puts 2, 3, 4 weeks out, you will have to withstand the volatility of going through earnings with your contracts. So it depends whether or not you want to do that. But one thing's for sure, if we dip down here and we do get some premium down here, 415 to 410, that will be very close to the big support zone down there with premium received. So I like playing Microsoft. If we dip, you can write down here, and it's very, very, very close to the big support area. So that's a trade on Microsoft. Another possible one up for consideration is if you guys want to start playing the TLT bonds, if you agree with the fact that CPI might have been a local bottom for bonds catalyst, we can use either TLT or TMF. I'm going to be looking to write strikes below the lows of CPI on TMF and TLT as well. We're not too sure if we're going to get those strikes because as of right now, there's not much premium there. But if we have a dip on bonds early this week, there could be a decent opportunity to go shopping there. If you are the type of person that wants to play bonds and wants to maybe accumulate some positions there, but if it doesn't get there, maybe you just get to collect some premium in the meantime. Some other conservative trades can be something like a Coca-Cola in the lower $60 range, 62, 61 on a dip. If you are looking to possibly play some Coca-Cola contracts, that would be a decent level. Coca-Cola is a breakout retest of a big resistance and now support range, looking for the retest and possibly run. So if Coca-Cola, I've been talking about this one for the last 3, 4, 5, 6 weeks on the channel and has been a good opportunity to play the put wheel down here as well. Same thing for UPS. UPS has been on the watch list now for a very long time in the lower 120s. If we get a dip down here in back, excuse me, into maybe the 126, 125, not a bad location to go shopping for some short puts, but you need to wait for a big dip to really be able to get the lower end of these levels. The lower end, by the way, guys, is roughly the previous resistance from 2018 through 2020. And now we're using that whole area as support after about 2 years worth of consolidation. So that one is also a decent little play that I'm going to be looking at on the watch list so far. Another idea as well is Nike. If ever we're looking to play Nike and we get the $70 flush, if we want to be bidding, there could be some okay premium down there, approximately around the $68 range. If you're looking to build a position in the recovery story play that is Nike, that could be somewhat of a decent idea. Another idea as well that is not ready yet because it's come off the lows is Uber. If Uber starts revisiting the lower 60s, all these plays, just put them on the watch list if they interest you, right? If Uber comes down again, I'll be looking to play them 62 down to $60, the lower end of this very large weekly support range down here, $60 down to 50, but I want to be getting as close as possible to 60 as possible if I'm looking to play Uber once more. And thereafter, guys, same thing for trades like Palantir or SoundHound. Palantir, $60. If we can find $60 again in the next few weeks, I'll be looking to write the $55 to $50 puts. And same thing for stocks, the momentum stocks like SoundHound. SoundHound, I really want to get as close as possible to $9, $10. So if we get the absolute flush on SoundHound, downtrend continuation, down into roughly the $10, $9 range, wouldn't mind playing it down there. It's just a play that I keep on the watch list. And if ever it shows up for me, I'd be willing to take it. So those are a lot of different trade opportunities and trade ideas. Obviously, there's many, many, many more in the market. I mean, we can even look at McDonald's. McDonald's is not that bad of an opportunity. Oops, let me pull it up. McDonald's down here, right? Roughly the 275 strike, 275, 270. Big support, big monthly support as well. As we can see, the 26 EMA is coming to this location as well. Big weekly downtrend since the highs, coming into that territory and daily oversold on McDonald's. All things lining up for a good area of confluence. Down here, 275, 272 could be a play on McDonald's as well. So there's a lot of opportunity in the market right now, so long as you know what to look for. So hopefully you guys are able to find at least some trade ideas through either the top 5 options plays or all of the bonus plays that I just gave to you right there. So guys, that is everything for me this week. Hopefully you guys enjoyed the video. If you did, consider dropping a like. Would appreciate it for the growth of the channel. Very close to 5K subscribers. So hopefully you guys can get me up there over the course of the week. Thereafter, guys, if you have any questions on the strategy as a whole, please feel free to leave them down below in the comment section, and I will do my best in helping you understand the nuances of the strategy. And lastly, guys, if you want access to all of my live trades, as you see me do every single week, pretty much throughout the week, we will see this down here, all my live trades, whether it's the wheel trades, the short puts that I take in terms of this strategy, the long calls, because I do also long calls, call debit spreads, put credit spread strategies, leap call strategies, swing share strategy, long-term portfolio buys. All of that is included in the live trades in the Discord. We also do morning live streams Monday through Friday for about 2 hours every morning at the open, where I trade live and answer all of your questions in real time if you want me to look at stocks. I also share all of my watch lists. So this entire options list, all of my watch lists, it comes with all my chart setups, all the annotations that I ever write on a stock or on the indexes, such as the valuations and everything. You guys get all my watch lists. Now, you also have private videos that I do for the Discord members, including a high-level strategies and psychology videos that I do not put on YouTube. And obviously, all throughout the day, you can ask me your questions in all of our chat rooms, and I am usually very quick to respond. So if any of that interests you, the link to the Discord is always down below in the description. So hopefully to see you in there soon. And if not, well, I guess I'll see you back on the channel, guys. That's it for me. Have a good week of trading. I will see you Tuesday after the close for our daily market recap. Take care. Have a great rest of your weekend, guys, and enjoy the holiday Monday. That's it for me. I'm out. Peace.